So hello everyone and very warm good afternoon to everyone and welcome to the Wiley webinar series. I would like to start this webinar by a brief introduction about today's speaker, Rahul Ghosh. Rahul Ghosh is a risk management professional of over 2 decades. He has advised over a dozen banks and over 100 business firms on risk management, treasuries, and derivatives. In some of his key assignments, he advised India's largest bank, State Bank of India, on ALM as retainer advisor. He has earlier headed the risk management team of the derivatives exchange NCDEX in India. He undertook assignment and implementations of the international PMFI standards applicable as an enterprise risk. Management for financial market infrastructure. Rahul also headed for 6 years the exchange-wide IT system that governed post-trade risk management for the clearinghouse brokers and clients. During this period, he graduated the capability of the post-trade risk management system to incorporate option contracts, which were then traded and managed successfully thereafter. Rahul is also the author of the book End User Guide to Risk Management and Derivatives published by Wiley. We are starting this webinar now. If anyone has any questions, they can ask at the end of the webinar or can type in the questions in the chat window. And the sir will answer them at the end of the webinar. Now I request sir to start the webinar.
Hello, I welcome everyone in the webinar audience. Happy to have you here. Today, I will talk about an issue that sounds topical, and it is a very difficult one at the same time, which is dealing with market catastrophes for businesses. Markets are a volatile place. Under difficult situations like the COVID crisis, the volatility can turn up very high and be outrightly disastrous. That is, catastrophic events in the markets. And markets have seen sharp volatility in recent times. The largest movements have been in the stock markets. But then we will not discuss stock markets here. Equity movements have been and are being intensely written about in newspapers and online sources. I am going to talk of market risks for businesses. While you already know this, let me recap by asking a question. What market risks do businesses face? While running a business activity, most firms must buy feedstock and convert it into the sale product. All of that feedstock and significant part at least of the sale product is commodity. That way, a large number of firms in the manufacturing sector get exposed to the risks of commodity price movement. Next, everyone borrows money. The more capital intensive the business, more is the need to borrow money. There comes the exposure to interest rates. Interest rates are not static. Interest rates move all the time, in turn moving bond prices and cost of loans. Again, corporates did not seek interest rate movements for their balance sheets and income statements, but then it's there. And that's not the end. Businesses have to buy components, machinery, feedstock, technical know-how, and a whole lot of stuff from outside their national borders. All of this must be paid for in foreign currency. They borrow some or sometimes significant part of their money requirements from overseas. Then businesses sell their products, know-how, etc. to buyers abroad. All of these activities require them to transact in foreign currencies. But then currency prices, again, move all the time. Sometimes they move a lot. Currencies, commodities, and interest rates therefore become market risks in three asset classes that businesses must face every day. So let's look at the recent movements in the base metals. Are a big market. By my estimates, around $400 billion of base metals are produced every year and form the basis for nearly $1 trillion of physical market in base metals. Copper represents this market the best, and copper prices have been volatile. Look at that graph. It has lost close to 20% of its value in recent times. The bloodbath has been in the oil sector though. Crude oil prices have fallen by more than 50% this year. This is truly catastrophic. Petrol and diesel sales in India have fallen by 2/3 or by 66% over the last month. During 2008 crisis, the crude oil price fall was even larger, much larger in fact. Then consumption had not fallen in any sharp measure, but expectations for future demand was pessimistic. Today, the consumption has fallen, but one sees significant recovery eventually. How long will it take? I have no take on that. The world's most traded currency pair of dollar-euro has been truly volatile, moving up and down. Makes business planning tough. The safe haven currency of Swiss franc, look at that graph. Not much different. The Indian rupee, look at the chart. It has been falling, significant movements. Perhaps we can also call it large movement given the relative stability of the Indian rupee at around 72 for a prolonged period. Now let us look at interest rates in the world's largest economy and also the funding market, the USA. The rates on the interest rate swaps capture the market rates well. Freely determined rates and representing a rating of around AA. The 5-year dollar interest rate swap rate has just fallen off. You can see rates were already low, and now after a sharp fall seem to be walking down to zero levels. The 5-year euro dollar interest rate swap rates representing the European economy, already negative, seems to be turning more negative. And that's the 5-year rupee interest rate swap rate, which is also falling. So the big question now, how to deal with market catastrophes? Can we deal with erosion after markets have moved? Actually, we can't. Losses that once occur cannot be recuperated. Attempting to claw back the losses would be like, bolting the stable door after the horse has run away. You would sure hear of strategies that can be undertaken to mitigate losses. But remember, to undertake such a strategy is to go down the path of a risky bet. Businesses should stay away from such beliefs. Can we all prepare for large or catastrophic movements? That is a better question to ask, really speaking. Objectivity and focus can be used in double harness by businesses to prepare them against losses from large market movements. It took a long time for the risk management approach to emerge. Initially, the risks were largely concentrated in commodity markets. The world had fixed exchange rates and fixed interest rates. All that started to change in the 1970s, with exchange rates becoming floating. Interest rates became volatile in the US in 1980s, leading to interest rate risk management emerging as a branch of study. But then we human as decision makers thought, what can someone really do when things really go bad? The approach was to do nothing, because if we are all going down, then there is not much to worry. Then it was found that some businesses survived even catastrophic movements. These were the ones that survived out of luck, or perhaps prepared well for the black swan events. Every business's ultimate goal is to survive perpetually. In that case, leaving things to fate is leaving open the possibilities of large losses that can in turn jeopardize the life of a business. That has brought the organizations of today to the idea of planning for extreme events, not willing to leave things to simply only the fate. So the risk management way is the path of planning. Plan, prepare, and plan further. Since we cannot recuperate losses, we should concentrate on making arrangements in such a way that prevents and helps us deal with extremely bad situations. And that cannot be a plan to prevent alone. To fight malaria, we need, we can keep our neighborhood clean, prevent water from stagnating, yet we need a plan B, What if malaria still strikes? We have to have a strategy to deal with it. So therefore we have malarial treatments with medicines, hospitalization care if needed, and so on. What I'm saying is that there has to be a two-pronged approach. This book on the screen is a step-by-step guide to managing risks. The book has a complete framework on negotiating market risks, and what I will bring here is some essence drawn from the book relating to the issue that we are discussing here today. So the more vulnerable a business is to market risks, greater the damage it will face from large market movements. This may sound natural and intuitive, not so straightforward to ease this vulnerability though. Therefore, the first level of preparation is to minimize the vulnerability. More specifically, the objective should be to avoid running large or unknown risks. How to achieve that is the question. This would require a structured approach. Risk reduction or risk, in fact, let's begin with risk identification as we have the sub-bullets here. Risk identification is the basic stage. We often feel an urge to rush through this stage and focus on the seemingly more important topics of risk measurements, For example, the value at risk, the MIS reports, etc. Yet, it would be a mistake to treat this stage of risk identification any lightly, because it is the building's base, building's foundation. It needs to be strong and it needs to be dependable. The effort invested should almost be invested in interest of better risk management. Not just more time is required to get this right. It is the quality of analysis that goes into it. The best and senior-most resources should be dedicated really to the cause of identifying risks truly. And this is a qualitative process. Here the bottom line is that if risk is identified correctly, only then is the measured value of any relevance. Let's look at measurement of risks. Now this requires quantification of risk, quantify risk. This stage is concerned with determination of the quantum of exposure. Let's keep in mind that this has to be done 3 times over. That is, for each of the respective asset classes of currencies, commodities, and interest rates. And again, remember, there is a lot of qualitative analysis and subjectivity here too. While we should be prepared to apply best of arithmetic or even mathematical models if we need to, the success in the field of risk management is not driven by mathematics alone or mathematics primarily. It is driven by understanding of the business, knowledge of markets, and applying all that to make sound assumptions. A model cannot be better than the assumptions underlying it. For instance, to assess impact of risk, a firm can choose from an array of time horizons. What time horizon it assumes has to be highly relevant to its business model. Mitigating risks. Neutralizing risk exposures is the surest guarantee against potential losses from adverse market movements. To hedge, how much to hedge? Hedge using what instrument or strategy is entirely dependent on the specifics of a business organization. Bottom line, risk must be reduced to a tolerable level. The risk framework is not just a piece of document. Sometimes it can get treated as a piece of document that does not help the cause though. It should be a functional piece of organization machinery. Preparing for market catastrophes. A good and functioning risk management framework alone is not a complete safeguard against market catastrophes. Businesses cannot get complacent with this. One has to prepare for bad situations. Preparing for bad situation requires an estimation of how bad can things get. Stress testing or scenario analysis should be the way forward, but let's not make it sound highly technical. These terms are often heard in the context of banks and financial institutions. Non-financial business firms can apply the same concept simplistically, retaining its essence. Okay. Consolidate exposures that can create damage due to large market movements, that is open exposures, residual exposures over a chosen time horizon. Estimate the losses arising from situation of high market stresses. Now consider if such losses are sustainable by you. If not, then you need a fresh strategy. Just as the risk framework needs to be functional mechanism, risk mitigation in crisis times also requires an organizational response. Doing that gets harder unless there is a pre-planned, predetermined plan of action. Predetermined means it should work like a piece of machine. A defined trigger beeps, then stop thinking. No thinking at all. Start acting. And then no need to think of a plan. Plan is there. Just start to execute your plan. If you just had a trigger go off, then you would start to bring your exposures down, weigh that against defined guidelines in crisis times. Who takes what decision is defined beforehand. So no back and forth movement between power centers within an organization. And having come this far in the presentation today, the likely question in everyone's mind could be that these are good words to hear. These are theoretical. It may not work in practice. And if there is an ambrosia, then gods will have it first. And the response to that is, yes, there is ambrosia available. It is up to us how we use it, how we acquire it. So asking that question more specifically, are there organizations that can shield themselves from market catastrophes? To answer that, I illustrate for you case of a largish company. This is a case of a petroleum refinery called HYC, based in Thailand. The identity of the company is, of course, not factual. This is to ensure confidentiality and privacy for the company. HYC used to refine about 100,000 barrels of crude oil every single day of the year. Profitability for HYC is a function of GRM. GRM stands for gross refining margin. It is arrived at by taking into consideration cost of feedstock and revenues from sale products. GRM is the health indicator of the refinery HYC. Crude is imported and refined fuels are sold in Thailand's domestic market. So company identified crude prices and foreign exchange rates as the two large market risks for it. Now, HYC built its strategies of risk management to ensure that large market movements should not devastate its GRM. It wants GRM to be immunized from vagaries of the market. Its hedge program was launched in early 2000s to give force to such strategies of GRM immunization. The acid test for HYC's risk management strategy came a few years later in 2008. The 2008 economic crisis was bad, and oil prices seemed to collapse through the floor. See this chart. Crude prices lost nearly 75% of their value in around 6 months. Can there be any market event more catastrophic? So the question is, what happened to HYC's GRM? In the face of such devastating impact, could HYC's, or for that reason anyone's, risk management strategy have survived? Could the refinery's gross refining margin have managed to remain inert or undisturbed from the market tornado around it? Let's find out. To find out, we will first look at HYC's gross refining margin, assuming no risk management is done at all. That would be to say the scenario of HYC not undertaking any hedging, that is, not undertaking any derivatives activity that would reduce or neutralize risks for it. Now, look at this GRM or gross refining margin chart. of HYC. On average and also median, HYC makes around 1 billion Thai baht worth of GRM every month. But the 2008 oil crash predictably throws all that out of the window. The refining margin is not just contracted. It contracts sharply. It turns negative and highly negative. What it means is that when GRM required to sustain profitability shrinks, the company most likely slips into losses. The GRM turning negative means that losses are unthinkably deep, a situation that had not been anticipated. Now let's see what actually happened at HYC. In reality, HYC had a risk management program. It used to manage risk, and let's see if that worked for HYC. The reality at HYC was different. There was no gloom. The GRM continued to be loosely anchored around 1 billion baht, as you can see on your screen, sometimes even slightly higher than that. So a well thought and executed hedge program ensured that HYC was immunized from market's temper. HYC was unaffected even during the most stressed period in history. You can find out more about HYC's business activities and its hedge program, profitability, cash flows, management decision-making process, and the transcript of board meetings. All of it in chapter 6 of my book, End User's Guide to Risk Management and Derivatives, published by Wiley. With that, I end my presentation. Thanking you for being with me and the Wiley team in this webinar. And I would be happy to take a few questions.
So now the floor is open for the question and answers now. So I asked everyone to type in their question in the chat window. So I able to see that there are a couple of questions already in the chat window.
So, hi, Rahul Ghosh here.
Yeah, so sir, yes, sir. So we have a first question over here from Rameshwar, and he asked that what steps medium scale companies should take to minimize risk in current scenario.
Right. I would like to tell him that not only medium scale companies, for just about any company, this is a stage where the risks have already taken place. When the losses have taken place, once losses have taken place, you cannot claw it back, right? It's like the horse has already run away. But what you can do is ensure that more horses don't run away from the stable. So to translate that for companies is that they should not run open positions. And this is also actually, let me link that also with the second question by Aman Chaudhary, which says that how long you think this market risk will go and how we can prepare for this through the risk management program. So the response to that will be that in the first question that we can't say that how long how one cannot claw back the losses. In the second question, we don't even know that how long will these market situations will last. The entire framework of risk management is based on the portfolio theory, which came in around early 50s, and uh, and, and also coupled with a few other path groundbreaking studies in the US and UK around that. And all of that believes in random walk. And a random walk means that markets cannot be predicted. So if your job is not to speculate in the market, then you should not think of exposing yourself too much to the market. And you should believe and understand that markets cannot be predicted. If markets cannot be predicted, then how do we prepare ourselves? The way to prepare is that we keep our exposure to market minimum. In the current situation, if you have large exports and imports for which you have not taken any cover, or if you have debt outstanding for which you have not taken cover, it may be a wise move to review that kind of a situation and bring down the unhedged positions that you have, bring them down maybe significantly. The more volatile a market that you are into, for example, if I were having, if I was having a euro currency debt, my borrowing currency was the euro, then I would immediately know this is bound to be a lot more volatile than simply a dollar loan, and I would definitely hedge the rupee euro loan to a significant extent. Again, it's the portfolio theory which tells us that the more volatility there is, the more the unpredictability and more there is. So overall, in every field, in a volatile time like this, I think people should reduce risk and carry less exposure.
So, sir, we have another question from Ajinkya. Does this volatile seems short-term and sustainable for long-term investors from capital erosion view?
It's hard to say, and that whether it's going to be a long term. In fact, as a risk manager, one should not take such a view, but other than what's going on at present. So what's going on at present has to be believed to be the best guide to what could be in the future. And at present, if you look around, we are away from development of a vaccine by a significant extent. Remember, these vaccines may get invented, they may come in the market fairly soon. But what happens is that for vaccines to be into the mass market, it takes up to 8 years. So we are not talking about 6 months or 8 months. We are talking about 8 years. So there are 3 stages of trial. And the vaccines are ultimately some sort of chemicals, which once they are injected into the human body, one does not know what kind of complications it creates. So with that, one expects that some vaccine will come, but for vaccine to be available en masse to the entire population of the world, I think that that kind of vaccine or that kind of drug may not be there for a long time. So travel restrictions, movement restrictions, and some kind of restrictions may be there for the near future, for the near foreseeable future, which also means that the economic activity will not be at the same scale for quite some time to come, or for quite little time to come, whichever way you look at it, depends. And therefore, this volatility is there to stay. And in this volatile period, companies should try and not and keep their exposures down to the extent possible. I think there is another question. How important are quality culture and a risk culture for effective organization management? Good question. It's the most important aspect. And risk culture, if we are talking about risk culture, really has to start from the top. It cannot be told in a company by the top brass that the people on the ground should practice it and it will percolate up. It has to start at the top. And one of the things is the right governance structure. The person who's dealing with risk, is the risk head of a company, should not have conflict of interest in his reporting structure. And there are a whole lot of things available. So overall, an effective organization requires, yes, a good risk culture. I'll look at the next question, Ajinkya. What are the reasons that hedging is not that familiar in India as compared to developed economies? Hedging is not all that unfamiliar also, as one might believe. In corporate India, for example, the banks anyway are keep themselves fully hedged to the extent, and their open positions are very small in India compared to their overall balance sheet size. Now that leaves the corporates. Now corporates do hedge a lot, and they are familiar with hedging. What differs between corporate to corporate is the extent of hedging that they do. Sometimes it is the wrong identification of risk, and therefore, even if they are doing significant hedging, it does not produce results. So these are some of the issues, and these issues are there world over. You will see many cases in that book about companies across the world, and there have been losses on misuse of derivatives, losses on not using derivatives, which we have seen from just about everywhere. Next question is Rameshwar. So the risk management should have a positive impact on the decision making. So in fact, decision making is the other way around. That decision making must take into account risk management. So risk management is a tool, it's a branch of study, it's a discipline that is available today that was not available in an earlier time. So it's important that the decision makers at the top give it more attention, pay more attention to this. So next question, how profits are made in a market like today's global crude, given the present volatility? Yes, I think as a risk management person, this is something that I would not like to talk. So, the only way that you can make profits in the market is by taking risk, not by reducing risk. So if somebody's balance sheet strength is so good, if somebody's cash flow positions are so good that they can absorb large losses if markets move sideways, then yes, in pursuit of profit, they could go ahead and speculate in oil markets and try and make money there. Otherwise, for companies, it should not be. So next question from Karthik is how will markets react after the lockdown? What do I think? It's a hard question. Frankly, it's difficult to see that far, that how markets will react after the lockdown. I think the markets will remain volatile until the full depth of liquidity returns into the market. So answering Aman, yes, the book has a lot of case studies. The book has 50 large case studies. So yes, you can always flip the book and look through the case studies. I think there's one question of personal. Sorry.
Yes. Yes, so we have one more question from Karthik, and he wants to know the difference between risk management and uncertainty in IT products.
So risk is more or less understood as the impact of uncertainty on objectives. So we all know that there is uncertainty, and if we if you're running an IT project, if somebody is running an IT project and knows that a few uncertainties that will be there in the IT project is that if it's an overseas project, that there will be exposure to currency risk. There could be exposure to economic conditions. Now, these uncertainties are there. So first, one needs to define what the objective is. And if the objective is to ensure that a margin of, let's say, 10% or 8%, whatever that margin is to be secured, then the entire risk management policy has to work towards that. Once, for instance, once your billings are more or less concrete, then can you make hedges? Can you make a hedging strategy? So that would be one way to do that. For personal net worth, to connect it to corporate strategies, I think that's something that I would not like to comment on. I think that's all. Do you have any more questions?
Sir, so I have a question, sir. If anybody after reading your book wants to connect with you, so whether they can connect it with some email ID or LinkedIn and can ask question over there?
Yes. So at the end of the book, my email ID is available, and I'll be happy to receive questions.
Okay, sir. So we have just a couple of more minutes left for the webinar. If anyone has any questions, they can ask it. So in the end, if you would like to say something about the book.
Okay. So this book is a project which tried to bridge three major gaps in the available literature. And these gaps are: one, the available literature is entirely on the entire literature on risk management and derivatives is entirely on instruments. It's not on the end user. So how to use those instruments, the books and literature is not available. There is some amount of literature on how to use risk management as a strategy application, but those are limited only to financial institutions. So we have 95% of the end user derivative market run by corporates, and yet there is no book for end users, the corporate. So this is the first gap this book tries to fill. The second gap is that the corporates face exposures across the asset classes of commodities, currencies, and interest rates, all these three. Yet the available books, there is no integrated literature available across these three asset classes of commodities, currencies. So we have a lot of books dealing on the instrument side, on interest rate, and on currencies, especially much more, but very thin on the commodities side, and certainly no literature, piece of literature where commodities can be combined with currencies and interest rate to give one. So that was the second gap this book fills. The third is the unavailability of case studies. So we have the Whartons and the Harvards which produce beautiful cases, which help a lot in bridging the gap between theory and practice for anybody who's attending their full-time MBA or attending their courses, their executive development programs. Now that gap doesn't get filled in our country or in our kind of environment because we don't have enough case studies which can give a fulsome view. So the third gap is for filling the third gap. The book has 15 case studies, and these 15 case studies are actually condensed version of about 75 case studies. Because to understand every aspect that needs to be covered, probably one needs a large number of case studies. So therefore, some of these case studies have been designed in such a way that large number of issues get about 4 to 5 major issues get dealt in every single case study. So chapter 1 and 2 is theoretical background, and chapters 3 to 17, those 15 chapters, are case studies.
Thanks, sir, for giving your time for the webinar and sharing the best knowledge. So for this session, the recorded webinar will be live on Wiley India YouTube page. And thanks everyone for joining the webinar today. And thank you, sir, for the wonderful session.
Thank you, everyone.